Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. We recently wrote that it appeared the stock market rally, which itself was being fueled by optimism surrounding control over the coronavirus outbreak, had disengaged from the reality of a global economy that had succumbed to a hard stop, something unprecedented in modern times. The news flow surrounding the outbreak is turning more positive by the day, and as my colleague Tim Kelly recently wrote, after noting all of the positive developments on the prospects for improved treatment and ultimately a vaccination, that it doesn't take much imagination to see a healthy recovery in the hardest hit industries like tourism and travel once our ability to deal with COVID-19 renders it no more fearsome than a bad seasonal influenza. But the bad news about the economy may be only just ramping up, and a renewed geopolitical spat between the United States and China is the last thing investors want to see. 3 weeks ago, we wrote here at the blog that even if we get the virus under control, the optimism in the market may turn to dismay when investors appreciate the depth and reality of the resultant economic challenges. Workers unemployed for extended periods suffer from a reduction in the relevance of their skills. Uncertainty surrounding employment and income prospects thwart spending, as does the plunge in savings. Meanwhile, dependence on welfare rises and supply chains are damaged. It simply takes time for the economy to fire up again. Given the market's pathological impatience, it seems incongruous that they should rally so hard and so fast. A test of the lows is as probable as a rally to new highs. And that statement should tell you something about how we see our job. We're happy to share our thoughts with you about what we think might happen next, but when it comes to managing funds at Montgomery Investment Management, predicting markets is not our job. Our job is a simple one: to find high quality businesses, we recently published a short list of some, and to buy them when trading at what we deem to be rational prices. Now, when markets are on their knees, there is certainly a higher chance we'll find the value we seek. But when markets are less cheap, opportunities may still be available. After the recent rally, broad value appears to be elusive again, and so we have knuckled down to the task of working through businesses individually, understanding how their revenues and costs of doing business are impacted, and developing a hypothesis for what their futures might entail. What we won't be doing is the kind of analysis we've seen starting to do the rounds all over again following the recent rally. Now, they're referred to as stock market analogues. The stock market's chart today is laid over the top of a previous period in an attempt to discern its future movements. The most recent example was in the UK's Financial Times at the weekend, showing how the market's most recent decade looks somewhat like the decade prior to the Great Crash of 1929. The conclusion I think you're supposed to make is that the next 3 years are going to be like the 3 years after 1929, and the market could fall as much as 88% from its recent peak to its trough in 2023. But how effective are such analogues? Well, the conclusion I've come to is not very. They make no sense at all. Because the companies that make up the market are different, they are impacted differently. And because interest rates, government and central bank settings, labour and productivity are all dissimilar, the drivers of the markets will cause a different reaction. This second example of a stock market analogue attempting to predict the market shows the S&P 500 up to late 2015, early 2016. And it appears to be predicting a substantial sell-off over the next 6 or 7 months. But as this chart shows, with the turning point of the previous one highlighted, the market did something substantially different to what was predicted. Now, you can find plenty of these predictions and analogues online. The point is that for any you find that were correct, substantially more were unsuccessful, suggesting that any that were right were purely coincidental. Instead of predicting markets, we will stick to the task of investigating opportunities by examining individual companies and their businesses and prospects. And whether the market does crash again or not, we are always well positioned to continue to perform that job. We look forward to talking to you again soon. In the meantime, continue to follow us on Twitter and Facebook.